Hello, good afternoon, everyone, and thank you for joining us today for what I think is going to be a very interesting discussion about the SEC's proposed new rules for private funds. We're going to be having two panels. First up, we will be having an investor-focused panel moderated by my partner, Claire Reagan, who focuses her practice on representing both institutional investors and sponsors of, institutional investors in, I should say, and sponsors of alternative investment funds. We will then have a sponsor-focused panel that I will moderate. For anyone who has been blissfully ignorant of the SEC's proposal, I'm going to spend just 2 minutes up front to set the table for our discussions. In February, the SEC proposed a new suite of rules addressing investment advisors to private funds, that is, funds relying on the exceptions from the definition of investment company provided in Section 3C1 or Section 3C7 under the Investment Company Act of 1940. The proposed rules have the stated goal of curbing certain conflicts of interest and providing investors with enhanced and standardized disclosure about fund performance, costs, and preferential terms. The proposal would prohibit certain types of activities and contractual terms, prohibit some types of preferential treatment or side letter terms, and require more detailed disclosure of all other side letter terms, and would also impose new standardized quarterly reporting requirements related to fees, expenses, and performance, require annual audited financial statements for funds, and require fairness opinions for advisor-led secondary transactions. So now I'll turn things over to Claire for the first panel and maybe give Chris a chance to take a victory lap.
Thanks, Adam. As Adam mentioned, I'm Claire Reagan. I'm a partner in the funds group located in Chicago. And joining me today, we have Igor Rozenblit, who is from Iron Road Partners and the former head of the SEC's private funds unit, Chris Hayes, from head of government relations at Celo Foundation, and former senior policy counsel at ILPA, and Heather Harlan, who's associate general counsel in the investments office at Northwestern University. So, we've heard that the goal of this legislation is to protect investors. So I don't know if our panel can chime in, and how did we get here? Was this something that LPs were asking for?
Sure. Well, I guess I should start on that, Claire. So thanks for having me. So I think this process really began back in 2009. So back in 2009, ILPA released Principles 1.0, which in the aftermath of the global financial crisis really set out what LPs think about in terms of fund terms. That was increased when 2011, when Principles 2.0 came out. And that process sort of continued from a best practices trying to work within the industry perspective with the 2016 release of the ILPA fee template, which I think is a major focus of the current SEC rules. And then from there, really an acknowledgement that given the state of the market, that engaging on policy issues, particularly with a friendly ear at the SEC, which had done some work around examinations led by Igor and his team and resulted in some speeches, really demonstrated that some policy changes need to take place. And so after that, we ended up moving forward to educating people about some of the challenges LPs saw in the marketplace. And then, first talking to Congress at ILPA about these issues, and then moving over to the SEC with the new administration coming in, where I think Chair Gensler was aware of these issues. There have been some legislative efforts, Stop Wall Street Looting Act, for example, some other legislative issues, the 2019 fiduciary proposal at the SEC, all of this sort of magnified the scope of the challenges that LPs are facing in the market and greater awareness at the SEC to address them, which resulted in Chair Gensler and his team seeking to move this forward. So maybe that's helpful as sort of a backdrop and overview of how this sort of started moving forward with a long runway of first working within the industry and then working outside the industry with policymakers to educate them about some of these challenges that LPs were facing in the market.
And I would just add to that, when I look at this rule, I see three real constituencies. One is, and the biggest one is LPs. So this rule attempts to solve some of the issues that I think the SEC believes remain around transparency and disclosure in the private equity marketplace and the private fund marketplace. Two, the other constituency is the exam program. So there are a number of parts of this rule that seem to have emanated from experiences examiners have had with private fund registrants, but also some challenges they've had in examining registrants. For instance, the written annual review requirement, wasn't really there before. And the third constituency is there seems to be kind of more of a philosophical, more of a political constituency that seems to have influenced maybe some of the prohibitions that are in the rule. But I really think that if you rank them in order, one is this is responsive to things LPs have been saying for years, if not decades. Two, responsive to challenges and observations on exams. And three, just kind of responsive to the politics of the day.
That's great. Thank you for that. And I don't know, Heather, recognizing that LPs are not homogenous, I was wondering if do you have a sense of how this has been received generally by the LP community?
Well, I would say, at least from the endowment perspective, I'd say we're just, I don't think we were surprised to see something. I think the breadth of the proposed rules was surprising. I think the private capital markets, private investments has comprised such a large portion of the investment world that I don't think we were surprised to see some attempt to impose some regulations on it. Overall, I'd say we're just taking a kind of a wait and see how it unfolds. And I'd say also we're just a little bit mindful that with such broad efforts, there's often unintended consequences. And, so I think we did not submit comments or anything of that sort, but we're just sort of watching how it unfolds for now.
That's interesting. Actually, in some of the LP comment letters that I read, CalPERS put one out, I think, and the Illinois State Board of Investments, they have actually mentioned the unintended consequences as well. And they kind of parroted a number of points that ILPA had made in their comment letters, but one thing that they both commented on was the preferential terms. And sort of, and for those that are not familiar, one of the facets of the rule is that a prohibition on preferential terms dealing with liquidity and information rights, and particularly the information rights. I saw both of the state plans coming out against, because they are sort of notorious in the community for needing additional information rights. So I don't know if you guys have any thoughts about that aspect of the proposal.
Right. I think we're not a public institution, so we don't have the same level of sort of side letter written demands that maybe some of the public plans and public universities do. And I would say the one benefit we could see is if there was some uniformity that would come with the reporting. But in terms of the actual reporting itself, I think we're, again, one of the unintended consequences could be that we don't any longer get information that we have historically because perhaps it's not required.
I'll just jump in here. I think, look, this wasn't something ILPA had asked for. And in fact, you see sort of a divide on the preferential treatment provisions between large and small LPs, right? So that was actually an issue we had somewhat to deal with as we saw the outlines of what Chair Gensler said in his speech at the ILPA conference last November, where this items beyond things that ILPA had called for action on, such as fee transparency and fiduciary duty, this issue had come up. And so we knew that larger investors maybe were receiving preferential treatment in side letters. But I think a deeper dive when we talked to many LPs, including some of the larger public plans, et cetera, was really that many of them were mostly concerned about this with their regulatory requirements for state reporting requirements, et cetera. And most of this was really just around disclosure of preferential rights that people had received. And I don't think other LPs care if other people know that they need something for California state law, for example, if that would be disclosed, more about their ability to receive it. And so I think that was where the trepidation was. But I think maybe as folks did a deeper dive into some of the technical details of the rule proposal, they saw that it's actually just about sharing that information. It doesn't mean that you can't receive a particular benefit if you're a larger investor. And in fact, in many funds, that's already being disclosed through the side letter compendium process. But obviously, this is a bit broader than that. And maybe there are preferential economic terms, but our understanding for some of the larger fund complexes, that's not as common as it used to be in terms of fee breaks, et cetera, or people are already realizing that through strategic relationship agreements or first close structures where certain investors are getting a fee break or preferential economic rights. That's already sort of transparent in the process. So I think LPs brought that up, larger ones, in their comment letters. That was their focus. But I think it's really around more clarity about what that means and what is included in those information rights, what's included in this rule, as opposed to being completely hostile to it.
Thanks for that. And any thoughts on the liquidity aspect of it? I spend a lot of time in the open-end fund world where it's a lot more of an issue, and it actually ties quite a bit to the information rights. The only concern I've really seen stated on the LP side is that, certain LPs have regulatory reasons. A foundation might have to get out for excise tax reasons if they start to hold more than, 20% of the fund or something. Have you heard any concerns on that front?
Clara, maybe I'm misunderstanding the rule, but there are a lot of hedge funds out there and a lot of our clients that have multiple share classes with different liquidity profiles and different fee profiles. And that structure allows LPs to choose the kind of liquidity that they will achieve. My read of the rule, and maybe this is not the correct read, is that those structures might no longer work, which I think would be a big issue in the industry.
Yeah, I've heard that concern as well. There, Adam's jumping in. So
I definitely agree, Igor. I think that seems to be very much implicated. That those kinds of multi-share class structures that have different, where you're trading liquidity for fee, for a different fee structure, I think are, as proposed, would be prohibited.
And I guess if you're an LP, no LP really objects to that kind of structure, because when they sign up for the fund, they get to understand exactly what their options are in terms of fee and liquidity provisions. And there doesn't seem to be an issue with that kind of structure that I can tell.
I would agree completely. And in fact, you may select a portion of your investment in something that has a longer lockup and a portion of it in something that has a shorter lockup, just to meet your own liquidity needs. So I would hope that in the final rules that would no longer be prohibited.
I mean, my understanding was this really came just in conversations with the staff, the commission, was something that came out of the exam sort of enforcement section sort of wish list. I think, obviously ILPA more focused on private equity than the hedge fund space, given that's not as much of our expertise. So I think we were less cognizant of challenges there, and certainly wasn't something that we were encouraging to take place.
Yeah, and I think that if that's the case, Chris, I think maybe it missed the mark a little bit, because the issues on exams and the kind of the enforcement cases that were made public really revolve around preferential liquidity for investors that did not expect to achieve preferential liquidity, and involved usually some sort of conflict of interest. And I think the Falcone case, which I think is now 10 years old, is kind of an example of that.
Yeah, one of the, I guess, themes, and you guys talked about, knowingly investing in different share classes and informed decision-making. And I guess that gets to the whole crux, and maybe we'll let the sponsors raise that issue of they not needing the SEC to regulate that. But one of the aspects, which was kind of surprising to me, was, the requirement that all, material, I forget the exact standard, but basically material side letter terms had to be disclosed, preferential terms, prior to an investor making the investment, because the MFN process, doesn't typically work that way. And I don't know if you see that as a meaningful right for LPs to have that ahead of time. Seems like a logistical problem, I think, wearing my other hat as a sponsor.
Well, I think Chris would know, but I think the ILPA letter does comment on that. And Claire, I think it takes the same position that you do, which is that it's administratively difficult, and really brings us back 10 years when I think side letters were routinely distributed among all investors. And I think that practice kind of fell by the wayside because it was difficult to execute.
Yeah, I think that's right, Igor, that the letter addressed that.
Right, and I just say, I mean, that would not be something we would be pushing for. It seems like as you mentioned, logistically difficult.
Another big focus, I think, on the LP side has been the provisions on fees and expenses and the changes that they're making on that front. Which I don't know if you want to comment on that. I can summarize for the audience, but I expect Chris is smiling. He probably knows well what the proposal is.
Look, I mean, ILPA's been working on fees and expenses for a long time. I think, the fees and expenses speech, the famous sunshine speech, as we all talk about it in I'd say the policy space, really woke, I think, a lot of LPs up to that issue that, hey, we're being charged things. The SEC's found that we're being charged things that we didn't agree to. Seems problematic. That resulted in more SEC engagement on that and more LP awareness of that topic, which is why the ILPA fee template was released. And I think while we saw a number of GPs endorse that template, which was great, we also saw that many folks were trying to get this information in the market, particularly smaller LPs, and weren't able to get it. And we thought that was sort of fundamental for a long time. And we were trying to solve this through the industry towards encouraging LPs to all ask for the template, push it forward. But I think our last calculation was about maybe 60% adoption across the marketplace. And so we felt that, all investors, including the smallest investors, should be on a level playing field so that they know what they're being charged and that it matches what was contractually agreed. Unfortunately, this often gets conflated into the things that people should or shouldn't be charged, whether a private jet should be charged or whether fees are appropriate or not. And I think that misses the mark here, where it was really about, if we contractually agreed something, how do I know you're actually charging me what we contractually agreed without regular reporting on that? And, that was what the fee template was tailored to do. Unfortunately, LPs were having to choose in the negotiation process, given the current market dynamics, between accepting less transparency for maybe a better, negotiation in other areas. And we just didn't think that transparency should be subject to the whims of the marketplace. It should be something that LPs should receive so they can verify that information. And so as a result, we felt that it should flow from the GP. It should be a requirement. And so ILPA actively pushed for a mandatory fee and expense reporting requirement, which ultimately resulted in this rule in the US, but also language that is currently likely to be adopted as part of the AAFMD in Europe. And so ultimately that'll allow even the smallest LP to know what they're being charged, maybe where they're just lucky to get access to a fund. And that was quite fundamental. I think if you look at the fee and expense reporting requirements in the rule, we were really conscious and encouraged the SEC in this process to focus on creating something that wouldn't tie to, say, the ILPA template, or wouldn't create a new SEC template that wouldn't be able to be updated as different trends and fees and expenses that are being charged changed. And so we wanted something that would last for the long term, that would allow the SEC to tailor through guidance or examination enforcement efforts, what made sense based on what they were seeing in the marketplace and various changes. And so I think the SEC did a great job of trying to achieve something that's quite difficult to do here in the rule. I think, and as raised in the ILPA letter, the real concern is that certain LPs may have requested certain LP level reporting rather than just, so you as the LP would receive something that's specific to you rather than the fund as a whole. And that it was really important that that reporting continue, and really that the SEC fund level reporting should be sort of the minimum standard, and
Yeah,
that not a maximum. So that was
Yeah,
quite
I think- sorry, I was going to say the ILPA comment letter and the CalPERS and Illinois letters both said that exact thing. They want this to be a minimum, not a maximum.
Yeah, and I think what's really unique about certain pension plans, this was another reason why we were pushing for this, is that certain, particularly the state of California, every California pension plan has a requirement to get certain fee level reporting from their managers. And so if I'm a small county or city level pension plan in California, I'm at a bit of a disadvantage versus other LPs competing for allocation and getting that needed transparency. And so you saw sort of this actions at the state level that really called out for a uniform response that would require GPs to provide it to all LPs in their fund, putting everyone on equal footing rather than certain LPs by virtue of state transparency requirements having to negotiate for more things than other LPs. And so that created sort of this problem, federalism problem in the market that, I think the SEC is also addressing here.
The other part, Claire, of the fee and expense provisions are some prohibitions around fees and expenses. And, I think if you talk to the staff and you ask them, well, what was this prohibition intended to target, they could pretty clearly tell you what it is. And the issue really here is in drafting. So for example, one provision is clearly targeting accelerated monitoring fees and only accelerated monitoring fees. But the way it's written, where you're prohibited from collecting fees for unperformed services, could capture a lot of different other things. And really the challenge with that kind of wording is that 10 or 20 years from now, we're really not sure what the industry is going to look like and what the fee stream is going to look like. And to the extent that those prohibitions prohibit future practices, they could inhibit industry growth in a way that doesn't really benefit LPs. But what Chris was talking about, the reporting is a huge, in my view, a huge positive for the industry. It may increase costs, but I think overall it's just a huge positive.
Yeah, and Igor, I'll just jump in and say, there's always that trade-off in costs. And look, LPs are picking up the cost for it. And we had those discussions all the time at ILPA about what is the right balance here, right? Like we got in this industry, so we weren't investing in 40 Act funds. So it shouldn't have the same structure, but certain protection should be there. And we're going to pay for those protections, like fee and expense reporting. And I think the calculation is that we're willing to pay for that information, but we're only willing to pay for information that's actually useful. And so that's why it was really important to engage with the SEC as they think about these rules, so that don't create regulation and requirements that don't actually add any value for the LP. And I think we're trying to be careful about when we engaged on these things with the commission about that. Sorry, Heather, I think you might have been saying.
No, I was just going to say, I agree. I think that at least on the reporting of the fees and expenses, that would be welcome to have some uniformity and could ease, for both LPs and GPs could create more efficient if there's, a more uniform type way of reporting these, just across managers. When you're tracking, several hundred managers, it is nice to have somewhat uniform reporting.
So two of the prohibitions are sort of related, at least in my mind, on the prohibition for charging sort of regulatory expenses of the advisor, and then the prohibition for any indemnification, any indemnification for a settlement of it, like an SEC investigation. And in particular, I have a sponsor that I fought that settlement point with quite a bit. And so I was wondering, Chris, do you have any background? Was that specifically targeted at anybody?
Sure. I mean, I'll give maybe a story. Let's just say a large public pension plan that was a member of ILPA had come to us with a real challenge, right? So they had adopted a position, I think back in 2016, 2017, with a number of these enforcement actions against larger managers had taken place, and they had instituted a policy that, hey, in our agreements, in our side letter, standard side letter, we're not going to agree to pay the manager when they actually violate something that was a violation of the SEC against the fund that we're invested in. I mean, it's kind of like, why should the LP pay for your wrongdoing? It never really made sense. But that was just sort of the nature of the market. And unfortunately, that LP, many other LPs didn't have that position, and certain large GPs they wanted to invest with basically said, we don't like that term, we're not going to accept it, so you can't have access. Unfortunately, this particular LP, they maybe thought about changing their policy, which I actually think rewarded bad behavior, unfortunately. But by doing that was leaked out to the press, and they were in a difficult position of losing allocation, but then trying to do the right thing. And so, we had brought them in to meet with the commission, talk about this issue. And, I think that maybe could have influenced why this was adopted, but I think it certainly, when you think about whether, yes, sometimes penalties and disgorgement and those sort of things aren't actually charged to the LPs or the fund, the biggest cost usually in these things is the legal defense cost for the GP in the process. And so I think there's a feeling like, why are we picking up the tab for that when you've done something wrong? And, fundamentally.
Yeah, well, that's the excuse, the justification I've been given by a very large sponsor, we would all know, was that, was the expense thing. They thought that in the best interest of the fund, they were just going to settle the litigation and save all the legal costs. It was actually going to be cheaper for the fund overall, so it was fair for the fund.
And I mean, I think, to me, the legal cost is a good point. The other provisions seem to me to be much ado about nothing. I think most managers already pay their compliance expenses, and most enforcement orders have a provision in them prohibiting the GP from passing on their disgorgement and penalty costs to LPs. But the legal costs are a different matter, obviously.
Yeah, I think you're right about that on the enforcement side, but I think it was really, that indemnification legal costs for defending the GP when ultimately did something wrong. So, or they settled the case. And so maybe that's where it came from. I think on the compliance expenses, you would know that better than me, Igor. I think our understanding is that it was sort of mixed on whether GPs were charging those expenses to the fund versus the advisor assuming the cost. But
yeah, I don't know in practice, but I'll tell you, there's been proliferation in LPAs of at least the ability to charge those costs to the fund, which maybe, sometimes it's lawyers just updating for sort of best practices to cover, and sponsors not actually doing it, but I don't know. One big thing, and I've heard from some LPs that, it's a hard topic for them to talk about, is sort of the new fiduciary standards that they're imposing, specifically the requirement that you can't indemnify for simple negligence, which is a great deviation from current practice. And I can let you guys comment on it, but I also thought it was interesting what some of the LP comment letters said about it.
Well, I think, first of all, this is sort of a very technical issue. And there's a lot of history at the SEC, as we learned engaging on this at ILPA. First, we had submitted numerous comment letters back under the Clayton SEC in regards to their interpretation of the fiduciary standard for advisors, and really became more widely aware of this practice of diminishing fiduciary duties diffuse throughout the LPA and LPs being really unable to maybe improve that. Even some of the largest investors basically just getting some side letter provision that says they'll take the investors into account when they're, when they're making investment, when the whole concept of the Advisors Act is really around putting the fund ahead of your own interest. And we had seen obviously a variety of enforcement exams results where GPs were putting their own interest ahead of the fund, which is a little bit surprising. And so, we looked at the technical elements of the Advisors Act, and a real challenge was that the Advisors Act wasn't really congruent with, it said, okay, under the Federal Advisors Act, which LPs actually can't enforce in the agreement, you can't get rid of your fiduciary obligations, particularly the duty of loyalty, which was most implicated here. But then under state law, or Cayman or Delaware law, where these funds are domiciled, you can completely remove those requirements and eliminate LP's right of action. And so the question was, how much could the SEC do to address this, right? And that was a real issue, particularly when public pension plans, for example, have their own fiduciary obligations to beneficiaries, and they're up there having to accept reduced ones from the managers they're giving, billions of dollars to. And so in the technical element here around negligence versus gross negligence, I think, ILPA really came down to the point of, look, we know gross negligence is widespread, but ordinary negligence should apply to material breach of the LPA and the side letters. So, I think that, it's difficult when you play in the space. I noticed most of the lawyers seemed really upset about this on the GP counsel side. But I think, it's encouraging folks to do the right thing. But I think LPs also, and ILPA acknowledge that, you want to be careful that you're not harming risk taking too much. And so that, it makes sense to have some limited liability in some places, but in other places, making sure that, managers are putting the fund's interests ahead of their own, which is kind of the whole point of the industry to begin with.
At the end of the day, you wonder if this provision is going to actually do what it is intended to do, because LPs don't sue their GPs for many, many reasons that have nothing to do with the indemnity standard, just like they're structurally discouraged from suing. And so I just wonder if this provision will increase insurance costs and increase legal costs, but in the end, not really result in much else.
I would agree with that completely. I'm not sure that it will have much of the hoped for impact.
I think when you think about this, we had this conversation at ILPA a lot about, what does it matter if no one sues for negligence, for breach, right? Or for breach of fiduciary duty, et cetera. And I think it shapes manager behavior when they're thinking about taking an action that could be a conflict or could lead to a conflict. The words on the page matter. So going to your LPA and saying, hey, can we do this or can we not? If you're more careful, maybe you're going to influence behavior. Obviously we're not going to expect to see LPs suing their GPs anytime soon, which I totally agree with. I don't think that's very common, but we do think it shapes manager behavior and ultimately outcomes.
I can't help thinking, Chris, that if you're investing with a manager who's checking his negligence standard in the LPA before taking some sort of action, you're probably investing with the wrong manager. Something is going wrong.
We're kind of running short of time, but there were two other points I wanted to just make sure we got at least a brief touch on from you guys before we turned it over to sponsors. One is one of the concerns I've heard about the proposal as a whole, and I think the negligence standard, may be one of the bigger areas, is that it's going to be, the rules may act as a barrier to new and lesser established managers. And are you at all concerned that it'll reduce your options for private equity investment?
I'll chime in on this. So this argument has been around for a very long time, and it was around when managers were being registered, and it's just never borne out. And private equity has continued to grow, and hedge funds have continued to grow, and I fail to see any impact on industry capital formation from this. There might be an increase in management fee. This might be kind of like the checked baggage fee in airlines, where there might be an administrative fee, but I doubt it'll impact capital formation.
And I guess last point, because it was a surprise to me, just because I assumed it was such an entrenched position in the market that I didn't even, I guess, dream that it would change, is the clawback not being allowed net of taxes anymore.
I'll jump in on this one. I think, look, LPs would never like bring this up because it's sort of settled practice, but they all hate the fact that they have to eat the taxes, especially the argument that it's the highest possible tax rate in any jurisdiction or whatever, however it's usually outlined. I think LPs know, GPs know what the taxes are that they pay, and they probably calculate them down to a penny based on the carry the manager is receiving. And so it really isn't fair when the managers decide to take a distribution that the LP should have to eat the tax consequences of that. I actually think this will be positive in making people more careful to avoid more clawbacks in the future. And from an LP perspective, the administrative hassle of actually doing a clawback process is, from what I hear from LPs, just a real nightmare. That, you know, these guys aren't trying to go to court and claw back money from people. They want to be investing and not dealing with that. So hopefully this will actually be a positive in the industry to have less clawbacks, which will benefit everybody, by making folks more careful about the tax consequences of doing so.
Yeah, I'll take the opposite side of Chris. I think what will happen here is that, well, just a quick step back, the reason that clawbacks are net of tax is because managers have the negotiating leverage to negotiate that. And so I think what will happen is just clawbacks will go away, full stop. There'll be no more clawbacks in private equity because managers have the negotiating power to negotiate clawbacks away. And even now, clawbacks aren't used very often. Even when there's a clawback effectuated, there's some negotiation that happens. So I think this will have pretty much zero impact on anything, but totally understand optically it looks pretty bad.
I guess I would say I think the clawback being net of taxes, I think most people did think it was settled, sort of just settled commercial practice, but LPs didn't like it. Perhaps if the clawback goes away completely, LPs will instead insist on some sort of escrow, because I don't think that, I'm not sure to what extent they would just want to agree to just no clawback with no additional assurance in the event there was a clawback situation.
Maybe
Well, that's how hedge funds work.
Well, maybe we'll just end up with more whole of fund waterfalls and just avoid the whole problem. You know, that'd be better for everyone. I don't know.
All right. Well, we better give Adam a chance here. Does anyone have any final parting words before we turn it over? Otherwise, thank you all very much for.
Thank you.
Thanks.
Thank you.
Thanks.
I'm glad to be joined now for our sponsor focus panel by George Chang, the General Counsel and CCO of Volion, an AI-focused hedge fund manager, Min Ta, Vice President of Public Affairs at Carlyle, and former SEC Commissioner Troy Paredes, the founder of Paredes Strategies, LLC. Let's dive in. So I want to pick on one issue that came up a few times during the first panel, which is we have a lot of the issues that everyone was talking about came down to sort of changing the commercial arrangement between advisors and investors. And really the SEC essentially putting their thumb on the scale and changing that commercial outcome, not necessarily disclosure requirements, but really saying, well, this is something investors shouldn't have to negotiate for. So we're just going to give it to them and let them spend their negotiating capital somewhere else. I'll kind of open it up to everyone to kind of give a reaction on, you know, how much of a sea change that is for everyone, and kind of the role of that the commission is at least attempting to play in this proposal. I don't know, Min, if you want to lead off.
Yeah, sure. I mean, I was going to defer to the commissioner, but I mean, I think, look, it was helpful to listen to the last panel, but fundamentally, I mean, the rule is a huge sea change. I mean, I think, I think Igor even mentioned it in parts of his comments. If you think about where the rule came from, I mean, I think it was helpful to have Chris talk about it. I mean, yes, there's been this dynamic with GPs and LPs for a while, but fundamentally, the reason why pension funds, like 45% of the investor base at Carla are coming to private equity, and I'll talk just purely the private equity side and have George talk on the hedge fund side, is, net fees, we still beat the public markets by 200 to 300 basis points. So the reason why LPs are doing this is they're coming to us because we can deliver a strong return for them. It's an illiquid investment, but that's ultimately why that's happening. And I think one thing you've heard me say this in other calls, but look, I mean, reading the 341 page rule, and Adam unfortunately knows I did read it, which is really unfortunate. The piece that drives me nuts as a Carlyle Group, we've been great investors. We love our investors. I mean, the notion, if you read, there's a thematic portion, I mean, I almost want to sort of challenge the presumption that, if you look at it, reading through the proposal, it says these poor LPs, they need to be protected. And then at the same time, they're not actually, they're pretty sophisticated. So you either got to pick a side on this part, right? These are very sophisticated counterparties. They use the same attorneys that we do, but also why would we do bad by our investors? I mean, given the highly competitive marketplace, that I think even in the SEC's release, the 68,000 funds, that includes private hedge funds as well. I think Mr. Gensler in his testimony today said there's over 50,000 funds. There's a hugely competitive marketplace in there. So why would we be, sort of want to screw our investors? But there is this notion that is, I would say, a mutual fund, registered fund investment space that is really applied in this rule. And when you read through the rule, it really comes across. And one thing I'll mention, Chris mentioned, some of the interactions, we love ILPA, we use the ILPA template, but let me just be clear. The Stop Wall Street Looting Act is very radical legislation that only a few members of Congress have co-sponsored that would basically undermine the entire private equity industry, along with everything else. I mean, they would add in risk retention back to Celos, which LSTA fought on and won, and it would upend the limited liability partnership, along with tax and carry interest. I mean, I think, unfortunately, this rule is largely a solution in search of a problem, and it's largely what the SEC couldn't do, through Congress, is what they're trying to do through rulemaking right now.
And I'll hop in on Adam, your question. Kind of from a big picture perspective, it is a significant change. I think apropos of what you were driving at, and look, nothing is purely this or purely that, but you think about the private fund space, and it's centered around disclosure and making sure that the parties have the information they need to make an informed decision, and whether they make the decision you would agree with, whether they make a decision you wouldn't agree with. Such is it, and whether one wishes that or would prefer that there was different bargaining leverage so that deals were struck differently than the way they are struck. Those are all fair considerations, but at the end of the day, the approach has been, let's make sure investors have the information they need, and then they'll make those decisions, and things will settle out where they settle out. That construct, that philosophy, which is, of course, as we know, persisted for decades, has come under some pressure, not just in this context squarely, but more generally in the advisors space. You think, for example, about increasing over the last, decade or so, there's been the view expressed in many instances that, well, in some cases, disclosure is simply inadequate. That for one reason or another, even with disclosures that don't suffer from any material deficiencies, it's still nonetheless inadequate to address in an effective manner a conflict or a potential conflict. That notion appears from time to time. You continue to go down that path, and jumping a few steps forward, you end up with aspects of what's in this proposal, which is to say, not only to be sure, more disclosure on a number of fronts, but in some instances, the SEC proposing provisions that would simply determine the substantive terms of the contract. That's a significant change. Now, some would say it's a significant change that's warranted and welcomed. Others would say it's a significant change that is neither warranted nor welcomed. That in some sense is the policy debate. But setting aside the policy debate as cast in those terms, there's, I think, an important point as I kind of digested what the folks said on the prior panel, which was really interesting and what's reflected in a number of the comments. And that is, when the commission, or any regulator for that matter, this is not unique to the commission by any stretch, starts to dictate substantive terms of commercial and business arrangements, the risk is the unintended consequence. The risk is, okay, well, if that provision is going to now have to take that shape and form, this other provision is going to change in some other sort of a way. And so what I think is really important, and again, unintended consequences is the way this typically gets referred to, is to think through, as you play it out, what would the LPGP arrangements end up looking like, generally speaking, on net, wherever that new equilibrium comes to rest. And on balance, and I think people would have their views on this, and they would probably be a range of views, is that a better place or a worse place? And all of that is to simply say that changing a provision here, changing a provision there doesn't tell you what the equilibrium is. It's a much more dynamic process that continues to be informed by bargaining power, leverage, competition, and the like. And I think that the input through the comment process is important on that, to make sure that wherever the commission lands, they're very much focused on the ways in which some of this may run counter to their objectives, notwithstanding their best intentions.
Yeah, so I think you picked up, oh, go ahead, George, sorry.
Yeah, and I was going to just jump in there. Like, I agree a lot with what Troy was saying in terms of the unintended consequences. You know, I think many parts of the rule like seem basically fine, like more reporting and more disclosure, like generally okay, and you might quibble with some of the details. But I do think that some of the more specific prescriptive items, like specifically around kind of indemnification, you know, I know that some people kind of think of this, oh, this is kind of mostly like an issue for the lawyers. Like, I actually don't think that's true. I think this is a pretty significant change in liability, and I think managers are going to perceive that. And like, if they were really focused on sort of duty of loyalty or other sort of specific Advisors Act breaches, like, I think that they could have gotten there or achieved that outcome in a more of a principles-based format, which would then sort of flow through. Because, you know, for example, like I think, you know, a lot of managers took the 2019 guidance around sort of no disclaimers of federal fiduciary duties like very seriously, and it sort of affected a lot of operations. But they didn't come in and say, well, this provision has to be written this way, and this has to be done sort of another way. And, you know, so from kind of a quant advisor kind of perspective, like this idea that you can't be indemnified for negligence is potentially like very troubling, because I think that we have all seen in really every aspect of our lives, like it's basically impossible to write bug-free code. And so if we make a mistake, like, is that our negligence? Like, I just don't know. And so I do worry about kind of the impact for quant advisors. And, I think that, like, I think Igor sort of talked about, well, there's not a real or kind of a serious concern that this will lead to greater consolidation in the industry. And I think I would sort of take the opposite view of that, which is, I think that we have continued to see a sort of increasing concentration, right, among sort of the largest managers, the amount of AUM, and as they have those resources, they have the ability to absorb something like, essentially a strict liability standard, whereas smaller managers, I think, are going to be, much more reluctant, right? And, essentially the kind of the individual persons to basically put themselves on the line under a strict liability standard. I think that I worry that is going to affect the market in ways that are pretty unpredictable. And it feels like, whatever the kind of using the analogy, right? Elephant gun to kind of like, shoot a mosquito. Like, I think they could have targeted sort of more specifically their concerns rather than coming out and saying, essentially, there's, managers are on the hook for all negligence.
Yeah, so I'm going to pick up on something you said and kind of marry it together with something that Commissioner Paredes said and something that Igor said, which is, kind of taking, let's just take the clawback issue as an example. The managers that are big enough to be able to negotiate and say, we're just going to do no clawbacks, or we're going to at least get rid of the interim clawback. The ones that can do that are going to be the ones that are already kind of attracting more capital than they can deploy even efficiently. Whereas everyone on the other side of the spectrum, the new entrants to the market, are going to be the ones that don't have that negotiating power and are going to get stuck actually applying some of these rules as written. And some people are going to be able to kind of just get rid of what would trigger those rules. And I think, George, to your point, it's sort of that, consolidating power, consolidating negotiating power among the largest, most successful managers, and leaving the new entrants with higher expenses, to comply, and less negotiating power to address some of these concerns. I don't know. I mean, from your perspective as, being at one of the big dogs, I mean, do you guys see this as an opportunity, or do you, I mean, I know, you have a perspective of, you generally do support a lot of the, and want to support some of the smaller managers in the space and want it to be a thriving industry. But how do you guys see this?
Yeah, I mean, look, there are definitely elements of, I mean, I think from the previous panel, Heather hit it on really well. There's a lot of unintended consequences, right? But ultimately, part of the way I look through it, just more from my perspective, is that I was on the Hill when Dodd-Frank was enacted. Guess what? The number one job in banks were in terms of hiring in 2011, compliance. So I don't think, I mean, this almost feels like the Dodd-Franking of the private fund space, right? So I think there's a lot of active competition now. I mean, you're right. I mean, I think, Adam, there's just economies of scale with, one of the trends that's happening, I'm sure George knows this and the commissioner knows this. And I mean, our CEO talks about this all the time. We're seeing more commitments from LPs that are investing in multiple funds, right? And that trend has continued. It's partly from the diligence perspective from the LP. We know the managers return really well for us. Why do we need to go through another process? So we're seeing that already happening without this rule in place, because some of the LPs want to go to consistent managers who've been able to deliver the funds and deliver the returns they're looking for. So I think part of it is, again, you got to take a step back. What problem are you trying to solve and articulate the problem? Unfortunately, the offering rule never really did a very good job about that, outside of a few enforcement actions here or there. But what is the exact problem that we're trying to solve in the private fund space? And I think George mentioned it really well. I mean, you're basically using a hammer approach here. I think that's the part that's problematic, not just for sponsors, but ultimately for LPs as well. I mean, I think you mentioned it. I mean, both CalPERS, I mean, I think ILPA mentioned it, but CalPERS also sent a comment letter. They were very clear about side letters. I mean, side letters are not a bad thing. If the commissioner has a $500 million commitment, and I have a family office with a $5 million commitment, sort of simple economics and capitalism should say that I should get some better benefits. But then again, as we know with the MFN status, if there are other people with similarly situated conditions with the MFN, to get those things. I mean, both ILPA, CalPERS, a number of the LPs are saying that this process actually works. And so I think that's what we have to sort of take a step back, is what problem are we trying to actually solve at the end of the day? And that's not really well articulated really in the offering release.
And I would say, so I think that the many of the kind of the principles are sort of admirable, and I think there are things that are sort of good and sort of should be supported in the rule. But I do kind of come back to this point where kind of we talked about earlier, where it does feel like kind of the commission is sort of dictating some terms, right, or at least has that as a potential focus, right? Because I think that somewhere in there, they're like asking comments about like whether 2 and 20, should be no longer permitted. And so like, I'm sure, there's a lot of sort of
page
debate about like
George,
the pros.
page 23 is where they have that. The page
Right.
143, they say, should we ban the American style waterfall? That is determining commercial outcomes. That is not
That's
the rule.
right. Yeah. And that's absolutely, it feels like there is at least an orientation in their approach here, which is I think beyond sort of the scope of really, kind of 211, which is like, are we really going to claim that sort of 2 and 20 is contrary to the public interest, right? Or that investors can't protect themselves? Because at the end of the day, if you look at sort of the net returns that managers are putting out, these returns, even after net of all of those fees and expenses, are still, often attractive enough to get, the largest investors to choose this, or the sort of some of the sophisticated ones. So I do really worry about that that thumb on the scale also.
So, Commissioner, I mean, I'll throw it to you. Obviously the SEC is using a very expansive reading of Section 211H of the Advisors Act here. I mean, is this something that you could have envisioned like a prior commission doing in this kind of explicit way from your perspective?
We didn't see a prior commission do it, so maybe you kind of run with that on the point. Look, I think somebody may have made a comment to this effect on the prior panel, which is there was an expectation the commission would do something, but I think even folks who are supportive of the general direction were in many instances surprised by the breadth and the scope and the degree of prescriptiveness of what this proposal entails. And listening to the discussion for the last bit, a common theme is look, there are certain things where whether again people agree or disagree about the need, it's disclosure and orientation. It's perhaps making it a little bit easier for LPs to access the information, digest the information, compare the information, to put that in somewhat more academic terms, lowering search costs and processing costs, which can certainly have its benefits from an efficiency perspective from that respect. But then there's the aspects of it that are much more substantive, as again, we've been talking about in nature, and that being not only the particulars, and there seems to be different views as to how consequential some of those particulars will be in practice, even the more substantive parts of the provision, but the change in approach. Again, the point that I think we've all come back to, the change in approach to be substantive in that way, if you will, to use the term of art in securities regulation land, a form of merit review in the context of the Advisors Act, if you will, where the SEC is making substantive judgments about what it thinks those contractual arrangements ought to be. That I think is the notable departure. And again, I'll come back to the point of and what are the unintended consequences. Even for those who are supportive of that philosophical shift, and undoubtedly some are, and even for those who might be supportive of the SEC doing something along those substantive lines in particular, I think there is even for folks who hold those views, I think a recognition that, but we do need to be mindful of the unintended consequence. I think it comes back to the comment period and the reopening the comment period in part. There may be lots of reasons for that. One being there's just a whole heck of a lot going on at the SEC right now, without question. But as the comments come in and you realize, wait a minute, our intention was to do this other thing. Perhaps we didn't draft it in the way that we would have hoped. Perhaps we didn't appreciate what some consequence would be as you play all this out. One way to wrap your arms around that is, of course, to allow more opportunity for comments to come in, but of course, allow yourself as the regulator more opportunity to digest those and give yourself the chance to make whatever those adjustments are that you think. So in short, we haven't seen a proposal this sweeping in this space. I think that perhaps is the best way to answer your question. And it is a very significant shift that really puts the commission down a different path in terms of how it thinks about the Advisors Act, which I'll end on one final note. You make reference to the commission's authority. There are interesting questions as to what are the limits of the commission's authority. How far does the anti-fraud authority and disclosure-oriented authority, how far can that take you when it comes to something that's more substantive in nature on the regulation?
Thanks. And I think I guess that, when we talk about the reopening of the comment period, I think there's obviously a very cynical way to look at that and say, well, this is just sort of arranging the chess pieces in a way that's going to give the SEC the best chance to survive any inevitable litigation. Or it could be something where, they've seen things come in the comment letters already that have caused them to second guess things. We heard during the first panel, comment letters from ILPA and CalPERS and others have raised some concerns about some aspects of the proposal. I mean, And do you think I'm being too cynical when I say they're not really interested in what else everyone has to say, or do you think that there really is some legitimacy to or legitimate interest from the SEC, and maybe we didn't calibrate this the right way, and we do want to give more people a chance to react and even react to the first wave of comment letters, essentially?
Yeah, I'm always leery to try to draw conclusions around what somebody's motives may be for a decision they make. But what I'll say is this, kind of drawing from my own personal experience. The commission as a whole, commissioners, chairs, the staff do take the comments seriously. Now, one may not always like the way they come out. That's a whole separate question though, right? Do you like where the commission landed? Do you like where any particular individual landed on a particular topic? That's a separate question from, did they take it seriously? And I have a ton of regard for the staff and for the commission as a whole. And I have no doubt from my vantage point that they're taking all this input seriously. And again, that doesn't mean that with an extended comment period, outcomes are going to change. But I think with the benefit of that input, there may be some changes they make. There may not be. I guess it's indeterminate at this point. But I'm gonna give them credit for trying to at least wrestle through the input, realizing that it's not all one way or the other, that there is a lot of nuanced input. Again, I think apropos of the discussion we've heard today, and that then gives the staff and the commission a fair amount to chew on, even those who think that the rule should proceed, a fair amount to chew on as they try to strike the right balances and make sure that they're achieving from their vantage point more good than harm.
So, Min, I mean, do you think whether it's the reopening of the comment period or otherwise, is there going to be pressure from the Hill, even from the the Democratic caucus on any of these issues, or you think about whether it's state pension plans that have a vested interest in maintaining their preferential treatment in side letters or otherwise, are there constituencies that are going to actually try to bring some pressure to bear? Do you think?
I think I hate to use sort of a very lawyerly phrase, it depends, but I think what I will mention is part of the reason why the comment period was probably, and this is more my speculation. I really appreciate what the commissioner said. I don't want to impugn motives of the SEC, but obviously I think a couple of things in my mind. The ILPA letter probably did not necessarily land the way they thought they would be. I mean, this is largely done for the limited partners, right? And if you read through the letter criticizes the negligence piece, says you have to grandfather basically all the private funds, which they should have done in the first place. And they talk about side letters as well. So I mean, those are fairly significant changes even within the ILPA letter they're talking about. So between that and 47 members of Congress did write to the SEC, including half of that membership, or 25 of them are Democrats who talked about it. I mean, honestly, I think what we largely can hope for, you don't want members of Congress engaged in this per se. I mean, not a ton of them actually know what capital markets fully are. So I think the ones who do are very helpful, but I mean, I think this is really where we need, the various stakeholders from the GPs and the LPs and to really talk through. I mean, one thing which, Adam's heard me rant about this, but LSTA, which is the main trade association for the CLOs, in their comment letter, right? And what does this sit in for with everybody here is that they had to justify the CLO waterfall in their comment letter. They actually have to say in their comment letter that the SEC rule cannot be met in terms of preferential treatment to prohibit the CLO waterfall, which is the basis of how CLOs are structured. So that's why I'm saying the offering release was really not ready for prime time. Hopefully through this 30-day comment period, we can, there's actually real engagement by the staff and the commissioners with the various interest groups to actually talk through some of these issues in a real way. I mean, but that's why one of these, at least on the CLOs, I give like that one specific example. In this, if you actually do a search in the PDF, the collateralized loan obligations don't come up once, and securitized assets. This rule is largely targeted towards private equity funds and hedge funds, right? But CLOs are also wrapped in as well.
So let's talk about CLOs just for a second. I think one of the big issues for everyone, but maybe mostly, or maybe it impacts CLOs at least in a somewhat unique way, is the lack of grandfathering that you just mentioned, Min, and some of the kind of special challenges in if you don't get that grandfathering, how do CLOs even go about amending their documents and getting consents from various, all the note holders that are needed when you may not even know who the note holders are? It just seems maybe ill thought through. But what do you think about it?
Yeah, I think of that. I mean, like you just hit the nail there. I mean, like it's given the CLO structure with the note holders, how exactly would you get consent of all the bond holders there? I mean, that's that to change the document. But ultimately, Adam, to go back to sort of like what we talked about is at the end of the day, I mean, Carlisle with 2,800 LPs across 450 funds. If you don't have grandfathering, I mean, that basically means the GP will have to renegotiate with the 2,800 LPs, right, across all our 450 funds, and ultimately the LPs are going to have to bear the cost as well. I mean, I think that's why ILPA weighed in on it. That I mean, the cost of both, and it's not just the LPAs, right? It's also the side letter piece as well. I mean, I think one of the things I've heard that the chairman at Gensler has said about side letters are sweetheart deals or not. I mean, as you all know, I mean, folks here in the previous panel knows, particularly with public pensions, there's certain things that they need. I mean, so the whole notion, I wish we can have sort of a not partisan dialogue about this, but that's real to talk about instead of throwing out, terms of, sort of like these are just sweetheart deals or things like that. Side letters are key agreements for LPs. LPs need that. So, I mean, I think, hopefully one of my disappointments, honestly, with this rule is that the SEC in my mind has always been a more, somewhat bipartisan, more, body that really wants to bring good policy. And I think, unfortunately, how this rule has been playing out, along with sort of the dynamics with that, many other rules, it feels like yet another institution in Washington that has been thrown into the partisanship mix, which is really, honestly, from a person who's worked in public policy for 25 years, very disappointing.
So, George, I want to throw it over to you for a little bit. We've talked a bit about, how I think from my perspective, the proposal is largely drafted, maybe even more narrowly than Min said, maybe not even just, private equity and hedge funds, maybe really just private equity. When you think about how a hedge fund manager would have to comply with some of these issues, like what to you is the biggest issue that, I know we talked about the simple negligence issue and coding, a fantastic kind of point to raise. Is that really the biggest one for you, or do you see other issues that, if this was adopted as proposed tomorrow, what would really be keeping you up at night?
Well, I mean, so that's obviously probably kind of one of them that's top of mind. But I think that, there are a variety of other aspects that kind of coming back to the prescriptiveness, like this somewhat arbitrary distinction between like liquid and illiquid funds and how you're going to do the reporting. Like, it feels like, again, they could have tried to articulate a few key principles about what they wanted to see in the reporting. And I know many of the commentators have kind of tried to offer that rather than this thing, because like thinking back, we're a relatively small manager, right? But now we're going to have to go through and sort of change all of our reporting and all of our reporting practices. And, you think about sort of what Min was saying with Carlisle, with however many 100 funds, like that is going to be like a massive undertaking of work. And again, sort of like, what is the benefit for the investors? Like, how specifically is this going to get better? And so I think from my perspective, what I worry about is kind of like barriers to entry, right? Like this rule will just sort of further raise the barriers to entry. And I know that nobody is whatever kind of, they are breaking out the small violin for kind of small hedge fund managers. But the reality is, like, you have to now have a relatively sophisticated sort of legal compliance and finance infrastructure to meet all of these requirements. And that is inevitably, I think, going to squeeze the sort of the smaller side of the market more, because the bigger managers just, have more kind of more AUM to kind of amortize this over. And so that to me, I think, is the broader kind of systemic concern, is that, like, sure, we can do it, right? Like, we can devote the resources and sort of do all of this stuff, but it is going to make kind of all of this stuff more expensive. And like, I think, kind of the earlier panel was like, yes, investors are happy to bear those costs, and sure, that may be the case. But like, these are going to be fairly substantial costs. And then on top of, let's be honest, right, products that are already quite expensive. And so we're going to be making them even more expensive. And it just, I'm it's not clear how much benefit we are going to get for all of the spend that is going to come in. And that is like, is it really like, on the reporting side, for example, is that really going to move the needle on sort of investors and their sort of appreciation and understanding of these products? Or, could this be sort of achieved like kind of hopefully like less intrusively? So I think that is probably the top of mind concern overall about the rule.
Yeah. And then I think you sort of have the question, and you were alluding to this a little bit, is are you staffing up and spending resources internally? Are you hiring an administrator to do, or is your administrator going to increase their fees for you to do all of this additional stuff that's going to be required by the rule? And how is that going to impact the economics of the fund? I mean, I think these are really all open questions. And I think, certainly, as Chris mentioned, and as the investor panel mentioned, if this really is the floor, not the ceiling that the SEC is setting out here, it could just be the beginning, because you're going to have to meet these minimum standards and then do more on top of that.
Yeah.
So I'll kind of open up to everyone else just to say, I mean, I know we're coming up towards the end. If anyone else has any final thoughts, then I think we have a couple of questions that have been submitted already. But I'll open it up to the rest of the panel for any final closing thoughts. Okay, fantastic. Well, thanks everyone. Let's take a look at these questions. We've got one directed to Commissioner Paredes. If you were a betting person, what are the chances of the SEC being sued if it adopts these rules exceeding its authority?
Wow. I guess I'm not going to put percentages on it, so sorry to disappoint on that. But part of the reason is I think it depends on where they land, right? Apropos of all of this, I wouldn't rule it out depending upon where they land, but I think one first has to see where they land, and the comment letters that I've had the chance to look at so far reflect serious engagement where folks aren't just saying, we don't like what you're doing, don't do it. Sure, there may be some of that, but where there's a lot of alternatives and concrete suggestions for how to improve it. And so now as the process goes forward, more of that, we'll see where the commission ultimately lands. And then I would imagine folks will assess what they think is the appropriate thing to do by way of a challenge, whether that's on authority grounds or APA grounds and the like. But I think those are judgments I'm sure that will be made down the road, but a lot probably will depend upon where this thing lands.
Chris, I'll invite you to turn your video on and say something out loud. I think I saw you typing something.
Sure. I'll just note, and I just typed this, but the GP Association's comment letters are all appear tailored for an APA lawsuit, laying out kind of their arguments so I would almost certainly expect a legal challenge. I think on the Congressional Review Act side, that is not an angle to roll this rule back, given the Biden administration would likely defend it, and they'll be in office till 2024. So even a switch in Congress to Republican control is unlikely to be able to fast track this rule backwards. So I would expect it to be litigated.
Thanks, Chris. And I would definitely agree with that. Not that I have any inside information into actual litigation strategy, but it certainly looks that way. And I think just given the obvious, significant impact on the industry, seems bound to happen. We also got a question of, would the SEC be okay just requiring advisors to state that they cannot disclaim their investment Advisors Act fiduciary duty? Why can the SEC, what can the SEC actually do about state fiduciary laws? So, as many people are probably aware, under Delaware state law, fund managers can disclaim or at least certainly limit their state law fiduciary duty. I think there is sort of a kind of a federalism question about whether the SEC can go out and say, well, here's what you can and can't do under state law. It's an interesting issue. So would the SEC be okay just about disclaiming of the Advisors Act duty? My personal take, and I'd be interested for our other panelists' views, is probably not, because they already sort of are there. I mean, that's the fiduciary interpretation from 3 years ago, or already sort of said you can't disclaim your Advisors Act fiduciary duty. That's sort of always been the case. So the fact that they went out with this in the proposal, to me, says they're looking for more than just that. but I'll open it up to my fellow panelists to see if anyone else has any other thoughts.
Well, you know what, it's just kind of like sort of thinking about the disclaimer issue. Like I mean, so from my perspective, like we operate, right? And I think most managers just operate as if you have these fiduciary duties, or you kind of think about them typically under your applicable state law framework, like so Delaware duties and also federal duties, because we recognize that even if you're able to disclaim the state law ones, the federal ones still apply. And so I would probably be supportive of, let's have, you know, an affirmative legend like you do sort of, you know, in kind of CFTC or kind of many other statements, like saying that sort of under, you know, the Advisors Act, right, we are subject to, we acknowledge and are subject to our fiduciary duties. Like, I think it's a thing that managers accept. And I think that maybe even forcing managers to put that in their documents would be a way to help them kind of internalize this, right, as a matter of practice and operation in kind of everything that they do. And I think that would be good for investors. I would agree though, Adam, like it feels like the SEC may be looking for more. And, you know, I think that's sort of the source of the tension here, because honestly, I feel like the fiduciary duties have worked for a long time, you know, and quite well. And I think that we could see more active reinforcement of the federal side, which is still a relatively new concept, you know, sort of in the industry. And I would support sort of more activity on that front, right? More, like a clearer and stronger place for federal fiduciary duties, because I think that that's a good sort of minimum sort of level of conduct. But, you know, again, sort of, I'm not really sure how that and kind of a strict liability standard are going to work together. That feels like something that's not obvious as a next step.
I'll just jump in here. I think, like, I mean, the federal fiduciary duties existed forever. I mean, since these have been advisors under the Advisors Act, they've had a federal fiduciary obligation. The real sticking point is the enforcement of that obligation, because there's no private right of action under the Advisors Act. So the SEC tried to address this back in the early aughts. I think the SEC versus Goldstein case is really the harbinger, where they tried to apply the federal fiduciary duty down to individual LPs in the fund. They lost that case. I don't think it was well argued at the time. I wasn't there, but that's created a series of case law problems for the SEC staff to address that they've worked around over the past few years. But this issue does persist in fund agreements. It's quite widespread, both under Cayman law and Delaware law, where these funds are domiciled, that you can eliminate your duty of loyalty and your duty of care. And it's really about LP ability to enforce those obligations, particularly the duty of loyalty, which is quite important. And so, you know, I think the SEC would have preemptive authority here. That would be my argument. But the political questions on both sides of the aisle of executing that are quite challenging from a states' rights perspective on the Republican side. From the Democratic side, it's state securities regulators hate preemption, and those guys are friends with the Democrats, so I think it's unlikely. So I think this was an artful way to try and address that issue, to ensure that, you know, this sort of incongruency between, hey, in my contract I say I don't have these duties, but over here under the SEC rules I do, kind of doesn't seem to be congruent with one another. And I think that was, you know, some of the issues that ILPA's tried to address. And, you know, a large number of LPs have sent their own signed on to comment letters to the SEC in that regard about their concern of these practices. And so, you know, anyway, that should hopefully provide some background.
Yeah, no, I mean, I think you can look at this and you can say, essentially, the SEC is indirectly trying to create a private right of action for investors in funds that they, you know, couldn't do by other means. You know, it's not there under the statute, but the rule could potentially effectively create one by you know, enforcing these contractual requirements on advisors, essentially.
I did want to bring up, you brought up section 211H, which I think is really interesting. It's actually the first time that statute's been used since it was in Dodd-Frank. And I saw a lot of comment letters from the GP side kind of saying, well, I read the legislative history about this and it's not okay. And it's kind of like, well, if you read the plain meaning of that statute, it's actually pretty interesting authority that the SEC has never exercised before, which anyway, just as an outward observer, I thought that was really fascinating. And how that is written, I mean, in the statute, you could drive a truck through it. So I think it's quite interesting how it was applied.
Yeah, no, I think
was
that's,
just like, yeah,
okay,
Chris, I mean, I think that we should have a debate about this, like in like this whole notion of, and Adam saying, creating a private right of action through an SEC rulemaking, maybe Congress should litigate this or have a broader discussion about it. That's problematic. I mean, I think that's where, even though, you know, you and I both know the lawmakers might not be the most sophisticated on capital markets, but they were the ones who were elected, and they are the ones who should be able to decide some of these matters. I mean, I think that's where the frustration comes on, particularly in this rulemaking, where a lot of it is being sort of thrown out there without, you know, where I think the realm should, whether for good or not, should be in the halls of Congress on a lot of these different things in this rule.
Yeah, I mean, I look, in normal circumstances, I would agree with that. I think, you know, there's existing authority for the SEC to do what it's done. Obviously, it feels comfortable in doing it and has evaluated those litigation risks. In terms of Congress, I mean, look, you know, there really hasn't been an opportunity for LPs to talk on Capitol Hill about these issues as someone who's worked on the past 5 years. And, you know, we had actually encouraged the adoption of a bill that was actually a discussion draft. We did not support the Stop Wall Street Looting Act, which I want to clarify, which you highlighted was extreme. And you know, we did not like it. And we went out and said that we didn't like many of the elements in it. But at the same time, there was a discussion draft called the Investment Advisor Alignment Act that actually was very targeted and tailored on many of these issues. Unfortunately, it was sort of subsumed into this debate about the Stop Wall Street Looting Act, and it just wasn't really an effective discussion. So I you know,
yeah, I mean, Chris, I mean, the title of the hearing was "America for Sale: Private Equity." That's what I mean. So it wasn't. I will note that was the title of the hearing. What do you?
There were 2 GP organizations invited to speak, and ILPA was not invited to speak at that.
I know, but I'm saying that was.
We had a very strong voice in that hearing, which the moderate Democrats were very much, along with all the Republicans, were on your side. So don't worry.
well, I'll come back to you, Chris. You know, for 211H, I mean, I think that is the question on any inevitable or any resulting challenge to the SEC's authority is really going to come down to that ledge history question of, is it the plain meaning? Is it where it was put, you know, section 913 of Dodd-Frank? Like, what's going on there? Like, time will tell on that one. I think it's much too early to say, but that is the question.
Yeah.
All right. Well, I know we are over our kind of originally scheduled time. I would just want to thank all of my panelists, my fellow moderator, Claire. Thank you so much, everyone. Thank you for joining us. I hope this was interesting and entertaining and maybe educational. Thank you so much for your time, and have a great rest of the day.